Hello and welcome. I'm Ray Ferrara, CFP, your host of the Up Your Assets podcast. Today, we're going to discuss the advantages and disadvantages of converting a traditional IRA to a Roth IRA. Converting a traditional IRA to a Roth IRA, often called a Roth conversion, can be a powerful financial planning strategy. It allows individuals to shift retirement assets from a tax-deferred environment to an account that offers the potential for tax-free growth. However, this decision is multifaceted and should be evaluated carefully, particularly in the context of current and future tax expectations, cash flow needs, estate planning goals, and investment horizons. One of the most appealing benefits of a Roth IRA is the ability to take qualified withdrawals tax-free. Because taxes are paid at the time of conversion, all future earnings, interest, dividends, and capital gains can be withdrawn without further tax liability, provided the account meets the 5-year rule and the owner is at least 59 and a half. For individuals expecting to be in a higher tax bracket later in life, paying taxes up front can offer meaningful long-term savings. Unlike traditional IRAs, Roth IRAs have no lifetime required minimum distributions for the account owner. This allows assets to remain invested and compounded for a longer period, which may be especially appealing for those who do not need to draw down assets during retirement. This flexibility also supports more strategic withdrawal planning and helping retirees manage taxable income much more effectively. Because the owner is not required to take required minimum distributions, the full value of the account can be passed to heirs who may withdraw the funds tax-free, subject to distribution rules, including taking all of the money within 10 years. This makes Roth IRAs useful for individuals aiming to leave a tax-efficient legacy. Tax policy is subject to change, and some individuals may believe that tax rates will rise in the future. A Roth conversion allows the tax to be paid now at known rates, hedging against the uncertainty of higher taxes later. Having both pre-tax traditional and after-tax Roth retirement assets provides flexibility in retirement income planning. Tax diversification allows retirees to control their taxable income year by year, potentially reducing the impact of Social Security taxation, Medicare IRMA surcharges, or general tax bracket creep. The most obvious downside to a Roth conversion is the immediate tax bill. The amount converted is treated as ordinary income, potentially pushing the taxpayer into a higher tax bracket. For those without cash on hand to pay the tax, converting may not be feasible or may erode retirement savings if taxes are paid directly from the IRA distribution. Because a Roth conversion increases taxable income in the year of conversion, it may have ripple effects on other components of a financial plan. Higher income can trigger Medicare premium surcharges, increase taxes on Social Security benefits, reduce eligibility for certain deductions or credits, or impacts financial aid calculations. These secondary costs can sometimes outweigh the long-term benefits of conversion. While pursuing Roth conversions to guard against rising tax rates, predicting the future is inherently uncertain. It is possible that future tax laws could shift the ways that reduce the relative advantage of a Roth IRA or make traditional tax-deferred strategies more appealing. Paying tax on a conversion requires liquidity. For individuals who must use personal savings or worse, must withdraw from the IRA itself, conversions can reduce total investment capital. This is particularly detrimental for those nearer to retirement or those without sufficient cash reserves. Roth conversions generally make the most financial sense when the investor has enough time for tax-free growth to outweigh the upfront tax costs. Those who expect to use the funds in the near future or have a limited investment horizon may not benefit. If you qualify to make a conversion, consider doing a little each year to fill up your current tax bracket. As an example, let's suppose a couple has $150,000 of taxable income. By converting another $50,000 in the traditional IRA, they stay in the same 22% tax bracket. 2 caveats: you must pay the tax with other savings, otherwise it doesn't make sense. And 2, you need to make sure that the additional income does not affect too negatively on the other areas mentioned previously. Be sure to visit with your certified financial planner advisor and a tax professional before doing a conversion. Now, go out there and up your assets.
This has been another edition of the Up Your Assets podcast hosted by Ray Ferrara, CFP founder and executive chair of Provise Management Group, LLC. The preceding presentation was for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show. The opinions expressed are their own and not the hosts or the show.